Depending on who you ask, cash will not remain king. The COVID-19 pandemic not only accelerated the shift towards digital and contactless payments, but also led to a more mainstream acceptance of physical cash alternatives like cryptocurrency. So, in order to understand if digital currencies will put banks out of business, it is important to understand the role that central banks play in the economy. Central bank policy making underpins the global financial system. The mandates for central banks vary between countries. For example, the Federal Reserve in the United States is responsible for controlling inflation and maintaining full employment. The Bank of England ensures the stability and solvency of its financial system in the UK. Central banks use a variety of tactics known as monetary policy to achieve their mandates. Mainly, however, they manipulate the money supply and interest rates. For example, a central bank might increase or decrease the quantity of money circulating in an economy. More money in an economy equals more spending by consumers and consequently economic growth. The opposite situation, less money in an economy, translates to one in which consumers spend less and a recession ensues. An example of this is through their policy making. Central banks played a key role in manufacturing the 2008 financial crisis. One of the responses to that crisis was Bitcoin. With its decentralized system and peer-to-peer technology, Bitcoin showed the potential to dismantle a banking system in which a central authority is responsible for decisions that affect the economic fortunes of entire countries. Tasking a central agency with an economy's functioning has its advantages and disadvantages. Perhaps the biggest advantage is that it builds trust in the system. A central bank issued currency is backstopped by a trusted authority and can be exchanged at a universal value. If each party in a monetary transaction issued its own coins, then there would be competition amongst the currencies and chaos would ensue. The problem with the structure is that it places far too much trust and responsibility on the decisions of a central agency. Debilitating recessions have resulted from improper monetary policy measures pursued by central banks. The complexity of the modern financial infrastructure has also complicated the roles of central banks in an economy. As money takes on digital forms, the velocity of its circulation through the global economy has increased. Financial transactions and products have become more abstract and difficult to understand. The interconnected nature of the global economy means that policy-making decisions and their errors by one central bank are transmitted across many countries. The case for digital currencies as an alternative to central banks is based both on economics and technology. Within the context of a financial infrastructure system dominated by central banks, digital currency solves three problems. First, it eliminates the problem of double spending. Each cryptocurrency coin is unique and cryptographically secure, meaning it cannot be hacked or replicated. Therefore, you cannot spend it twice or counterfeit it. Secondly, even though it is decentralized, the blockchain network is still a trustworthy system. In this case, trust is an algorithmic construct. Transactions on the network have to be approved by nodes spread out across the world to be included in its digital ledger. Even a single disagreement by a node can make the transaction illegible for the digital ledger. Thirdly, the blockchain network eliminates the need for a centralized infrastructure by streamlining the process to produce and distribute cryptocurrency. Intermediaries are not required for peer-to-peer transfer between two addresses on the blockchain network. Therefore, a network of banks chartered by a central authority is not necessary to distribute the cryptocurrency. Even though it solves these problems, most people don't trust them in the way they trust the US dollar, the euro, or even the Japanese yen, all of which are backed by a central bank. Despite the erosion of confidence in government institutions, most people still prefer money backed by a central bank, and that is unlikely to change anytime soon. Digital currencies and related technologies are likely to reduce transaction costs and decrease the price of acquiring and sharing information, which sounds good but can destabilize financial markets and intensify contagion from one market to another. They could undermine the business models of conventional banks and their role in the financial system, making it hard for central banks, which operate largely through the banking system, to maintain financial stability. Cryptocurrencies threaten financial stability in 5 ways. Firstly, customer protection. The hype around the high returns from cryptocurrencies has led to more fraudulent, get-rich-quick schemes lurking in dark corners of the market, and there's no protection for consumers who get scammed. Secondly, anti-money laundering and combating the terror financing. Cryptocurrencies were created as a way to take the power of monetary control away from centralized authorities, like the government and the central bank. So it's no surprise that the central banks take issue with not being in control. Cryptocurrencies have led to an increase in assets that can transfer funds with increased anonymity. There are virtual assets that focus on privacy. Think Monero, Zcash, and others. Decentralized platforms pose the problem of having no single entity to go after, if and when things go wrong. Privacy wallets and other new financial instruments allow for reduced transparency, which in turn obscures the flow of finance. Next is that they are prone to fraud. As things stand, anyone can launch a new cryptocurrency. There's no national framework defining what a cryptocurrency is, or the minimum requirement for it to be a legitimate investment option. This means that anyone can create a virtual asset, get others to invest in it to hike the price, and then cash out their stake without having to explain why. This is normally what is called a rug pull. After the founders or influencers pull their money out and other investors are left holding less than what they originally started with. Fourth, they're prone to extreme price volatility. Crypto's price can change dramatically very quickly. And lastly, its impact on monetary policy. Non-bank actors, which means crypto exchanges and other blockchain companies offering financial services, are adding to dollar funding stresses by using loopholes in the traditional policy approach to foreign exchange markets. Cryptocurrencies have also never had the accessibility to offer financial services that banks offered, such as loans and earning interest, and therefore banks remained fairly safe. Then came DeFi. Although created in 2015, it started gaining mainstream traction in 2020, and DeFi isn't merely yet another unwelcome disruption for incumbent banks. It could be an exponential threat. Through DeFi lending, users can lend out cryptocurrency like a traditional bank does with fiat currency and earn interest as a lender. The barrier to entry to borrow is low compared with that of a traditional system. In most cases, the only requirement to take out a DeFi loan is the ability to provide collateral with other crypto assets. Therefore, decentralized finance has the abilities that banks have, and as more people access them, the more trusted they will become. However, DeFi is much riskier than a traditional bank for a number of reasons. For one, there isn't regulation or insurance on your money when you use DeFi, and due to the volatile nature of cryptocurrencies, investors would need to be comfortable with large swings in price. If there's a downturn, the crypto asset used as collateral may sharply decline in value, and some investors may see their positions liquidated. Investors should only spend what they can afford to lose. This begs the question, does it have the ability to eliminate banks? And the answer is, it has the ability to, but the likelihood of it happening is extremely low. Why? Because banks are not foolish and will respond to the market in order to stay relevant. Banks are predicted to respond in a few ways, such as, firstly, making a move to integrate cryptocurrency. DeFi and cryptocurrency are part of a wider cultural shift, whereby consumers increasingly place value in digital assets, such as NFTs and crypto. If banks want to embrace DeFi, they need to embrace this shift by acknowledging that crypto is here to stay, and that there are trillions of dollars of value stored within it. A pivotal move would be to allow consumers wider access to that value via their banking services. Next, to embrace DeFi and help in shaping regulations. Financial regulators and central banks are crawling all over the issue of crypto assets and DeFi, recognizing that they can no longer simply afford to see regulations and compliance as ways to block this next phase of evolution. Incumbent banks need to align themselves with this activity, ensuring that they have an active role in shaping the future regulations via technical instruments. Third, create bridges and develop middleway options. Incumbent banks should be using their weight and resources to develop credible and trustworthy pathways between the centralized financial services ecosystem and the new world order of DeFi. Lastly is creating their own digital currencies. CBDCs, or central bank digital currencies, have far more in common with cash than most major cryptocurrencies and represent a natural digital evolution of traditional monetary systems. In comparison to other speculative cryptocurrencies and tokens, the CBDCs are created and offered directly by central banks and are typically backed in similar ways to cash, whether that's by gold or by reserves, thereby creating the trust and ensuring consumer protection. 4 key drivers that have pushed central banks to explore CBDCs are supporting the digitization of economies, streamlining current payment systems, enhancing monetary and fiscal policy, and lastly, improving financial inclusion. Issuing its own digital currency would prevent a central bank from losing market share to Bitcoin and other cryptocurrencies. Central banks are at the helm of the modern global financial infrastructure in the current economic system. An overwhelming majority of countries around the world use central banks to manage their economies. While it offers several advantages, this form of centralized structure vests excessive power on a single authority. On the other hand, blockchain technology relies on algorithmic trust, and its decentralized system offers an alternative to the current system. But cryptocurrency still has a minuscule adoption rate, and its legal status is still under a cloud. Meanwhile, central banks have co-opted elements of the blockchain design and technology to explore their options in the realm. In our opinion, it is more likely than not at this point that central banks will begin to introduce their own central bank digital currencies. Even though digital currencies and DeFi are a threat to banks, we don't think that banks are going anywhere anytime soon. They are more likely to adapt and evolve. This is our opinion. What is yours? Do you think banks will ever be completely eliminated? Let us know in the comments below. If you enjoyed the video, please be sure to hit that like and subscribe button.